And before we get started, I do just want to start off and just give everyone a little bit of perspective about who who Cornerstone and LPL are. I think it's always good to know that. So let's just go ahead and jump into that. First of all, who is Cornerstone? And many of you on the call right now might be asking that question because you've never heard of Cornerstone before. Well, Cornerstone, first of all, is a registered investment advisor affiliated with LPL Financial. We were founded in 2005. We have over 120 financial advisors across the country who are affiliated with us. Total client assets in that footprint are a little over 6.3 billion. And you'll see the breakdown in terms of how many we have in each state. Our headquarters are in St. Louis, Missouri. But again, you might be saying, okay, that's great, but I still don't know who Cornerstone Wealth Management is because I'm doing business with Ginfinity or Triada or LifeMap. Well, a lot of our advisors have decided to brand as something else and build their own brand, but still affiliate with Cornerstone because of some of the services that we provide to them. This webinar would be one example of that. Now, all of our advisors with Cornerstone are affiliated with LPL Financial. You probably already know who LPL is. Your statements come from them, but a few things you may not know is they are the largest independent broker-dealer in the country. They have over 20,000 advisors, which actually makes them one of the largest broker-dealers, period, in the country, with over 7 million client accounts and over $1 trillion in assets. And they provide us with the custodial services. They custody the assets, they send the statements out to you. They also give us all of our product availability for our advisors to use with their clients. And really what that means to you is support structure and scale, and ultimately more time for your financial advisor to spend with you and serve your needs. And how that all comes together is your independent financial is out there building their practice. LPL is providing all those services we talked about before, custodial, products, statements, and so on. And Cornerstone is then offering best practices, compliance, and additional services just to help that advisor run more efficient businesses, and hopefully that equates to a more or a better client experience for you. Our agenda today is to discuss the global economy, global markets, geopolitics, and then ultimately, probably most importantly, what it means for you, the investor. And I'm really happy to have our speaker with us today, Dr. Quincy Crosby. She is the Chief Global Strategist for LPL Financial. She's a member of LPL Strategic and Tactical Asset Allocation Committee. Some prior experiences in education. She was the Chief Market Strategist at Prudential Financial. She was also a Global Investment Strategist at Deutsche Bank Asset Management. She was a U.S. diplomat, both in Washington and U.S. embassies abroad. She was the energy attaché for the U.S. Embassy in London. She also held a position as the Assistant Secretary of Commerce. She represented the United States to the IMF, and she holds a PhD and master's from the London School of London School of Economics. So, Dr. Crosby, we are very, very happy to have you with us today. Thanks for joining us.
Thank you. And it's Quincy from now on, okay?
I appreciate that. I was going to ask in advance, but we had some technical difficulties getting you on, but I appreciate that. And by the way, we were supposed to have Dr. Jeffrey Roach joining us today, but unfortunately he had some travel issues and he is on a plane right now that was delayed from earlier today. So unfortunately he wasn't able to join us, but quite frankly, we got the important person on. So I think that's the main thing.
I won't tell Jeff you said that. Okay.
I appreciate you keeping that between us.
Okay.
Well, Quincy, what do you say we jump right in?
Yeah.
So let's just talk about the recession. I saw a piece come out today from LPL that said we likely did not have a recession in 2022. Of course, a lot of that economic data gets revised. And so sometimes we are able to look back and say, in fact, what we thought was a recession maybe wasn't. So my question to you is, okay, if we didn't have one last year, are we going to have one this year? If we have it this year, is it going to be a deep one? Is it going to be a soft landing? And then on top of that, tell me exactly when it's going to happen.
Okay, I'll give you the date, the time of the. And you know what's interesting, though, this is what's fascinating about it, is that the ultimate arbiters of who decides when we go into a recession and when it is the National Bureau of Economic Research. That group is made up of some of the finest PhD economists in the country. They meet regularly, but here's the thing. They wait about a year before they tell us when we went into a recession and when we came out. And when they tell us, I started on a trading floor and everybody would start laughing and we'd be like, thank you, PhDs, we really appreciate that, because we'd be out of the recession by then and everything would be fine. So what they look for and what we look for is the labor market. And the reason for that is that in our country, 70% of GDP comes from consumer spending. And consumer spending is based on, do I have a job, right? And therefore, that's why they're linked. So what they look for, the National Bureau of Economic Research, the NBER, is, do we see problems in the labor market? Does it crater? Does it move up to 4.5% or 4.6%? The reason I use that number is, in a previous Federal Reserve meeting, it was mentioned that maybe we were going to see inflation going up to there. Well, that's a level that's important, because then inflation, the labor market then impacts consumer spending. Then it also impacts the personal income. All three of those is what is looked at and monitored. So when a recession is called officially for the textbook, they want to see that for at least 2 or 3 months. So it isn't just a week phenomenon and then they say it's a recession. No, they wait a long time. So in looking at the labor market, right now we have unemployment at 3.5%. It's pretty darn good. And also, in addition to that, we are seeing what the Fed is focused on. What bothers them so much about the labor market? And why have they in the past talked about the need, if necessary, to bring down the labor market, to force it to cut wages? It's that wages had been climbing higher, especially on the side that is the service sector, which is actually the largest part of our economy. Everyone knows, you go into places, there are still signs today, help wanted, help wanted. You have to pay more, but here's the thing. That extra wage, those higher wages are an input cost. And then they're passed along. Hopefully, if you're the business owner, they're passed along to us, the consumer, and even to businesses. And they want us to pay so that they don't have to do it. That's how it works. And that is why inflation is underpinned by higher wages. So the Fed wants to break that cycle. The good news is, not good news if I'm working, the good news is that wages are starting to come down. This is important. In addition to that, we're seeing that the work week is getting a little bit smaller. In other words, a few hours coming off of the work week. That's telling us that the economy is slowing, not cratering. In fact, it's going back to where it was pre-pandemic. But when those hours come down, it's hard for the laborers to say, gee, I want more money. You don't see that together. And then one last thing is that we are seeing what's called the participation rate. This is the rate at which people who were not working come back in and start looking for jobs. And why is that important for this whole story about recession? What it does is it gives the employer a larger pool of potential workers. Therefore, you don't have two workers saying, we'll walk out if you don't give us more money or bonus, so on. So that's good news. And then here's I don't want to scare people, because this is where bad news becomes good news. We're seeing temp workers being let go. They don't show up in the monthly reports, but temp workers are being let go, not completely, but a little bit more and a little bit more. That's telling us that the economy is cooling, not cratering. We just got the GDP number for the fourth quarter. And the point is, you're starting to hear Federal Reserve officials now actually come out and say, just this past week, it may be possible that we can get to where we want to be in inflation without having to, really destroy the labor market. That's really good news.
Well, that, and you gave me a great segue to talk about inflation, and I appreciate your answer on recession, and certainly inflation is a part of that, because that's of course what the Fed was reacting to and
Yes.
trying to cool that. So it seems like most people agree that we've seen peak inflation for the year, or I shouldn't say for the year, but at least for this cycle. Now, the Fed's comfort zone, if we want to call it that, is 2% inflation. Big gap between where we are and 2%. So my question to you is, do you agree we've peaked? And then number two, do we ever get back to that 2%, or how long or how far off could that be?
That's the core of everything, isn't it? Right now for the market and the Fed, it's the path of inflation, or as they like to say technically, the trajectory. As long as it is subsiding, it's good news. It's not going to subside. I mean, the only way it would subside within a few months would be if we went into a deep recession very quickly and it got deeper and deeper. Then you kill inflation. They don't want to do that if they don't have to do that. But as long as they can see that inflation is coming down from the previous month and from the previous year, then they will be satisfied that we're moving in the right direction. And you're right. Their goal would be, because price stability, remember, that's the mandate, that the Fed needs to restore price stability. And that is 2%. But they would be very pleased if it goes to 2.5%. And, Chairman Powell likes to add an ish to everything. So if it got to price stability-ish, he'd be very, very pleased. But as long as it's moving in the right direction, and it has been, and now they have wages, we hope it lasts, coming down. That's what they want. And the other one that they pay very close attention to happens to be rents, because that in the consumer price index, the CPI, it represents over 30%. And it's a large portion of the average American's budget. And the Fed wants those rents to come down. They've started to. It will soon show up in the data. But remember, the data looks back. And we see from the industry reports, not anecdotally so much, but industry reports, that leases are coming down. And that's good news. It is the path, not necessarily getting there overnight, but the path that has actually comforted the markets and comforted the Fed based on the comments, the most recent comments from the hawks on the Fed, those are the ones that I pay attention to.
Yeah, and no doubt, and we're talking a lot about Fed policy right now, and we almost need to put Fed apostrophe S plural behind this, because this is really a global phenomenon. And so I do want to pivot a little bit and talk about the global economy and the backdrop that's happening there, because really we're seeing the same things play out really around the globe. So would you care to comment maybe on areas of the globe that are maybe a little more behind the curve than what we are? Maybe some areas that are maybe seeing more pressures from inflation than what we are, and what that might do to the overall global economy?
Absolutely. Well, next week we have the Federal Reserve on February 1st, right? They'll come out with their decision. Right after that, we'll hear from the European Central Bank, and that's the Eurozone. And this is interesting. They are a rules-based, the ECB, European Central Bank, is a rules-based central bank, meaning their only mandate is to restore price stability, which is 2%. They don't worry about the labor market. It's that, and they have to do it. It's not that, if, maybe, no, they've got to do it. So Christine Lagarde, who is head of the European Central Bank, made a comment just the other day. We're going to keep going. We've got to keep going. And so they may have a 0.5% rate hike, whereas we're expecting a 0.25%. Remember, we started first. The Canadians started, and they're on pause right now. They actually, at one point, came in with 1%, if you remember. So they're right now saying, hey, you know what, we're just going to pause. The Fed came in, and we may have to remember this, they started very light. It was 0.25%. And then they moved to 0.5%. And then 0.75%, and 0.75%, and 0.75%. Now we expect February 1st to be 25%. They feel like, I believe they feel that they have come in with the medicine. The medicine is in place. The medicine is working its way through the economy. And then let's see how that medicine actually works, see how it's working. They don't want to destroy the economy by any means, but they want to make sure that inflation is extinguished and they move back to price stability. This is Jerome Powell's legacy. So Christine Lagarde, the same thing. She in many ways has a more difficult task, because if you think the US is large, try to imagine having those countries with different how shall I say it, different economies, all have to have the same thing. And that's a difficult job, but she's determined to bring in 2%. So she started late, they started small, then they moved to 50 to 50. And they also had 75 at one point. So they're doing that. Now, here's one that's really interesting, is Japan. And the reason I mentioned Japan is that, by the way, it happens to be the world's third largest economy, following China, which is the world's second largest economy. And we are still the first. But when Japan collapsed, and it collapsed decades ago now, the markets collapsed, the real estate market collapsed, and they had deflation. They had deflation for decades. And what's deflation? It's don't buy it today because it's going to be cheaper tomorrow. And wages, to get wages up, the government had to go in and negotiate that and give tax breaks because they wanted to increase wages. They wanted to induce inflation, create inflation, because when you create inflation at a logical level, not hyperinflation, it is a different psychology. You know what? Buy it today, but you don't have to if it's not hyperinflation. Prices will be stable, but they'll go up. So, but don't put it off. Don't think it's going to be cheaper and cheaper. So that's what they wanted. Well, guess what? Now they have it. They had introduced not to get technical, but they introduced some years ago a way to keep their bond yields down. And that was a goal to increase inflation. But the very same, as you alluded to, the very same factors that increased inflation globally also pushed inflation up to 4% in Japan. And now that they're looking at, okay, what are we going to do now that we actually have inflation, something they wanted. Now let's go to China for a minute, because that's the world's second largest economy. They are coming out of COVID. The zero COVID lockdowns that everyone would see in the news, that's over. Now it's just plain COVID, and it's voluntary quarantine, if you will. But nonetheless, they don't have much inflation. They couldn't. The economy was locked down. In fact, the economy languished. It was one of all of the developed markets, was one of the worst performing markets. So inflation was hampered by lack of consumer spending, lack of manufacturing. Everything was sluggish because they literally locked down portions of the country for months. Shanghai, one of the most important and populous parts of China, was locked down just recently for 2 months straight. So you don't have inflation in that situation. In fact, you have essentially recession. So they aren't. So that's what's so interesting, is the world's largest economy, US, have inflation, raising rates. China, the second largest, and Japan, the third largest, not raising rates at all. It's very interesting. And then the rest of the world. So many of the central banks have stopped. They had begun maybe even a little bit before we did. And we are on the path towards the end of the cycle. Most likely it's going to be in mid to late spring, if not sooner. And that's the good news for the market.
That is great news for sure. And we're going to talk in just a minute about how sometimes the market and economy don't necessarily move together.
Yes.
I do want to ask you one more question before we pivot to markets. I do want to ask you a question about China. And you talked about how, again, they were in recession, very deflationary type environment. Now they're reopening, they're coming out of the lockdowns. And I think you could look at that in one of two ways. You could look at it as ultimately this is deflationary for the globe because they were a supplier of many goods at lower prices. And so you could be seeing goods coming back to market, supply chains getting eased and so on. But they're also the second largest economy. And so if they come back in and they start to compete for natural resources, energy, and so on, it could be another inflationary force. How do you see that? Do you see it as being inflationary or deflationary?
That, at Davos, Davos took place where all the elites go. And that was a major theme. China in and of itself was a major theme. Every aspect of China was a major theme. But just what you're talking about, but like everything else, there was a tug of war over inflationary or deflationary. And when I say that they were recession-like, I'll call it recession-like, the economy just languished. They come out with their numbers. The West doesn't necessarily follow all of the numbers that they put out. They still showed some growth, which is slight growth. It wasn't recession, but still, it was it's hard to even describe what happened there with zero COVID lockdowns. But nonetheless, most of the building in China took place early in the early 2000s, right? 2001, 2002, 2003, with huge amounts. I can remember the numbers on cement, iron ore, copper. I mean, you name it, just pushing up the super cycle. That's what we called it. We called it a commodity super cycle. And in fact, they are the world's largest importer of oil. That's one of the reasons that the expectations of oil demand are actually going up now. The International Energy Agency putting out a report just a couple of weeks ago suggesting that coupled with supply constraints, you also now have China most likely coming on board maybe in second half of this year as they come back from the Lunar New Year, still with COVID, get over that and then start. So most likely what they're focused on now is consumer spending. They have made that a priority to have personal consumption picking up. Now, whether they do that by lowering loans, lowering the rates, I don't know how they're going to do, but it is a priority. And how do I put this? It looks as if already Chinese, obviously many of them going home right now for the Lunar New Year, but many of them are traveling outside of China. We expect that when they come back, and hopefully COVID has stalled, it'll be similar to the West, how we went out wanting to go out to dinner, going out to get a cup of coffee. And this is important for investing, in fact, and how Western Europeans as well prepared their lives after COVID. We're expecting the same thing in China. So, however, with all of that said, you're seeing more and more banks in the US putting out lists of companies, American companies and European companies, and some then they go into emerging market companies and Japanese companies, of how Chinese spending is going to help these companies. I'll give one example because it's a perfect example. I'm not suggesting that anyone invests in this, but I read the research report. It had to do with Starbucks. Starbucks has, very popular, and by the way, despite Chinese versions of Starbucks, they're very popular in China. And the analyst who gave Starbucks an upgrade said, you know what, we may see a slowdown in the US if the labor market is hurt in America. However, it will be complemented by a pickup in demand in China as the Chinese come back and go out and go back to work, go back into the cities. We believe that Starbucks is going to get a boost. For every Starbucks, there are other companies, I won't go into it in this call, that look as though they are going to be beneficiaries of an opening, a true opening, not of just a reopening, but an opening. And that is going to be important. Chinese have saved money. Someone asked me on a call yesterday, Bill, Quincy, where do they get the money? China has more billionaires and millionaires. It's not like they were able to leave. They couldn't. They were locked down also. And so they spend it. Now we know that they're traveling. We could track it almost. But the point is, China is going to be boosting up. Your question, does that mean that they're going to be building more airports? Are they going to be building more cities? How many more cities can they have? What they're trying to do is to clean up the property market. The property market is a major portion of Chinese GDP. Some even say 25% of it. However, it's debt laden. It's debt laden, and they are all, the big ones are all seemingly on the verge of bankruptcy or default. China wants to clean that up. So the question is correct, but do they need to build more airports right now? They have done all of that. Now, needless to say, they're going to do some building. They're going to need iron ore, and that's why. But how about this industry, the electric vehicle industry? That is a focus for them, and we know palladium is there, copper is there, all of those. But it's not going to be a repeat of building infrastructure the way they did over these last, 20 years. You can only do so much. But I will share with you another need for the platinum, copper, and so on is in the military. China, even during the downturn, building the military upgrades, their Navy, they have more naval ships than we do. That has been a top priority. It is going to continue to be a top priority. And that area needs these fine metals and minerals. So that's going to be important because they're not going to stop. They're going to continue to do it. But I don't think it's going to lead to a major shock in prices, maybe pre-pandemic. How about did we have a super cycle pre-pandemic? No, the super cycle eased off. So you have to ask, what are their priorities? Is it to build new cities? They've got cities that are ghost towns.
I'm going to ask you a little bit more about that military buildup when we get to geopolitics,
Okay.
for sure. But
I love that. Favorite.
Good. Yeah, I thought it might be. But so let's say I want to pivot and talk a little bit about markets. And we've already touched on this a little bit. We talked about that idea that good news for the economy is bad news for the market and vice versa. We've talked also about the market sometimes moving before the economy does. So it doesn't necessarily, you don't have that validation for the move until after the fact. Why is that? For the people listening in, why does the market sometimes move before things look better? So, okay, I said I started on a trading floor, right? You have a different perspective when you're working for global proprietary traders. Those are the guys who trade the firm's own money, right? With leverage, lots of leverage. But they would always say to me, remember, Quincy, the market gets the news first. And so just to give you an example, if I'm thinking, oh my goodness, there's a recession, it's just around the corner, the economy is going to be negative and we're going to stall. Why is it when I look at the days that the market is climbing higher now, do I see the cyclical side moving higher? Why is that? Why am I seeing not necessarily consumer staples, these are our necessities, but rather discretionary things that I don't really necessarily need, but I see money going into that, correct? On days, for example, when the CPI, Consumer Price Index, comes down, and tomorrow we get the Fed's preferred inflation picture, and I'm going to say it, PCE, now I'm going to say it, Personal Consumption Expenditures Index. I got that right. We'll pay attention to that. We're going to pay attention to, has that eased? Now that typically runs a bit cooler than the Consumer Price Index, but we'll see how much cooler. If it is, and if we see a rally in the market, we're going to pay attention to the sectors and subsectors that lead the market higher. One thing I've noticed, it's a bellwether. It is the semiconductors. The semiconductors are in everything. Your refrigerator can talk to you, your toothbrush, but missile systems have semiconductors.
Electric vehicles have a tremendous, actually more than fossil combustion engines vehicles, all need semiconductors. They are in everything. And there was a shortage. Remember when used cars were leading the inflation chart because the auto industry didn't have enough of the chips or other parts. But the point here is, on days that we have rallied, the semiconductors almost out-rally everything else, right? They have been a global bellwether for some time on global growth. And you got to ask yourself, and you wish they could talk to me. They're so smart. Why can't they talk to me? And I look at them and say, you're telling me something. You're telling me something. And then on days that the markets are climbing higher, we will go from consumer staples, which are all the things that we use every day, to, again, more discretionary, things that I don't necessarily need. Those are climbing higher. The point here is, Bill, is that the market telling us, Quincy, in a couple of months, the Fed's going to be finished. Yes, we may have a sell-off in the stock market, because very often we do before we come out of the bear market. But after that, this is what's going to be happening. Look at the timing of it, Bill. 3 months down the road, we should have a very clear picture of where we're headed, even with the stock market. Even if the stock market has to sell off because a slowdown in spending, compressions in what we call margins, and then the stock market has a deep sell-off, the valuations, the cost of the market comes down, it becomes compelling, and then the Fed is just about finished, and it leads you to the exit. It leads you to the exit. And that is maybe what, on the days that we see the market climbing higher, it's telling us this is what's around the corner, Quincy. I can't, once I saw the semiconductors, these are the chips and everything, starting to just shine. Now, I do have to say this about the market. January can be considered a very good time for the market after all the tax loss selling that you have in December. We had a lot of it in December. The history books are filled with February. Okay, I'm glad you enjoyed January, but we're going to pull you right back down. So again, this is a market that needs to see what are companies saying, especially now that we are in the earnings season. What is the guidance? Because the earnings season is looking back, is it not? But guidance is telling you about tomorrow. Guidance is telling you. And here's the interesting thing. When Microsoft came out with their earnings the other night, the initial reaction in the futures market, because it was after hours, was higher. And it started to pull back when the CFO, Chief Financial Officer, started to speak. And she said, I know that we had a slight uptick in revenue. Growth was the slowest in 6 years, she said. And she said, our customers are telling us that they're slowing down their spending. That pushed the market down. Contrary to that is Tesla. The numbers come out, there was a muted response until Elon Musk got on the call and talked, and as he's talking, that share price is going up. The point is, the market is hungry for guidance. And coming out of this earnings season, we still have a lot more to go, by the way, at the end of this week, next week, and the week after, we will have a sense of what companies are telling us, not surveys, not anything else. What are companies seeing? And this is why it's so important, more than ever, to hear what the companies are saying. The credit card companies, for example. I want to hear what they know everything about us. Almost too much, it's almost scary, but they know, and we want to hear what are they seeing in the different segments of the wage earners, business spending. We will have a good picture, and that, again, could be a trigger for either a sell-off or to say, you know what, it's not as bad as everyone thinks.
Quincy, we've talked a little bit about stocks and some sectors that might be kind of leading indicators of sorts, what might lead out of this recovery. You mentioned the word history books or historic at one point, and one comment that you just made, and I want to talk about historic in the context of what happened in the bond market last year.
Oh,
And obviously, difficult time for an investor who had bonds, which they normally think of as the safe piece of their portfolio. And to oversimplify a very complex market, if interest rates go up, which they did, bond prices are going to go down. But could you maybe just give our listeners an idea of just how historic that move was? And then what are some thoughts going forward for this year for the bond market?
yeah, excellent. The only way I can describe it, it's not very scientific, is the bond market just basically listening to the Fed, a Fed that's going cold turkey on us, a Fed that's saying, I gave you tremendous liquidity yesterday. I gave you a market that was virtually free of risk. And now I'm doing the exact opposite. I am tightening. I'm starting quantitative tightening, which, by the way, is the opposite of what they were doing, meaning they're taking their balance sheet and they are unwinding it. The very same medicine that the market was given because of COVID, right, of bringing interest rates down dramatically so that we would spend more. Mortgage-backed securities, that's another thing they bought, so that the housing market stayed stable. The housing market didn't stay stable, it went through the roof, right? And so they started a process which is the exact opposite of what they did to keep the economy afloat in early part of, or during the pandemic. And now they're saying, guess what? This is all over. We're turning off the spigot. Not only are we turning off the spigot, we're taking it away from you. The bond market, to use a really scientific term, they freaked out. It was like, what? It was all hitting it at exactly the same time. It has calmed down. It has become a remarkable barometer, by the way, of what the Treasury market thinks is going to happen. In fact, tomorrow I'll be paying attention after the PCE, the inflation report, comes out to see where the 2-year Treasury yield is, because that one is a remarkable reflection of what the Treasury market thinks is Fed policy. And we'll be keeping our eye on it to see, do yields go up, do yields go down after that report tomorrow, on another report on inflation. And so it's calmed down. And another thing that's really important is that on the investment grade side of things, on investment corporate bonds, companies went out into the market borrowing money during the easy money period. They all, high yield, formerly known as junk, they were able to get money, as much money as they wanted to replenish their balance sheets, and they did. So companies are still flush with cash at this point, and they offer tremendous value for investors. In many ways, I have to say, the bond market has become the historical ballast that it has been. And it is yet again becoming an increasingly important part of the portfolios, not just on a retail side, but institutional. So it means that the equity market, while still very important, obviously, for our portfolios, it's not the only thing. We also have very attractive yields that we can get from the Treasury market, guaranteed yields that we can get from the Treasury market. And as you pointed out, you're a great teacher, Bill, you know that when prices go up, right, where do the yields go, and vice versa. So it is a, how do we say it? We were so afraid in the early, when things started to stabilize, to come out and say, hey, it's stabilized. You know, Lawrence Gillum, who was a fantastic bond guru for us, he said, I want to say, you know, we should be going into the Treasury market. And he said, Quincy, you're doing a Bloomberg show. You're going to come out and say that, right? I said, I sure am. I said, we need it. It's happening, and it's stable. It's not stabilizing. It's already stable, and it's remained stable.
Well, Quincy, I appreciate you expanding on that. And you already answered a question that I had in the what it means for investors to some extent in terms of is that 60-40 portfolio dead, which we'll come back to that in just a little bit. I do want to get into geopolitics because number one, I knew looking at your background, that would be an area that you loved. And at the same time, I think it's something that's on everybody's mind. Why don't we start with domestic politics? We just went through a midterm, regardless of the outcome. I think we can all agree we're happy it's over. That seems to be a universal agreement there, regardless of what happened. A lot of things we could talk about with that, but one that is hitting the news wires almost on a daily basis right now is the debt ceiling. Could you talk about, again, just what that means, and then where you think this might be headed in the next few weeks?
Yeah, okay. It's, what do they say? It's complicated. When we saw that Kevin McCarthy having to go to 15 rounds, right, that too was historic in modern times. We've seen it worse in the past, but we tend to think, oh, that was then. This is more modern. We get it done. But in order to end it on that 15th round, he had to tell the holdouts, yes, I will cut, I will not cave. I will cut but not cave. The holdouts, for the most part, were those who said, we want that budget cut. We don't want to lift the ceiling. We want it cut so that we don't have any debt. And he had to agree to that. He was not going to get the votes. I mean, they were adamant. Then you have the other side of the aisle, which is we're not negotiating anything. So it makes for great headlines, does it not? And so what happened was the Treasury Department was able to do some figuring. You ever see when you go to the check-in at the airline and you're looking and they keep typing and they type and they type and then suddenly they found a seat for you? Well, Janet Yellen was typing and typing, and so she found some money. She put it in there, and now it may not be June, which is the date that we already thought. It may be in August. So it's a lot of time to do something that they all say they're not going to do, which is negotiate. Right? They all say we're not going, but we know right now this talking. The two sides that are talking, obviously the extremes on each side are still duking it out, but they're talking. Nobody wants to see this happen. No, I mean, it's going to get ugly, but nobody wants to see it go off the cliff. I mean, that's different than extending the discussion. However, there is tremendous anger in the country regarding Congress, as everyone knows. And it has to do with the fact that they get full health care, they have pensions, while the average American is paying for health care, paying for pensions, right? Have financial advisors. But also, the average American says, wait a minute, I paid into Social Security. I paid into Medicaid. This is not a benefit. This is not a benefit. And you even had President Trump come out publicly just recently and to his cohorts, right? Those who are very much in line with him, and he said, don't mess with Social Security and Medicaid. Just don't do it, because it's not a winning strategy. Like, so many Americans live on Social Security. So there's no doubt, however, that the budget has ballooned, and it is ballooned every single year. And if we don't do something about it, taxes are going to go up exponentially to pay for all of this. There is no doubt. I mean, no doubt. That's the only thing you can do. And nobody wants to do that because that's difficult. It's not a winning solution. The solution is to cut. Now, there is a move that comes out in the headlines, but I do know that they're talking on both sides. And that is to have a small committee, not an unwieldy committee, but a small committee to come up with the cuts that they want, to see how much they can take out of the budget now and in the long term. So that's a possibility. But we get questions all the time, Bill, about, okay, Quincy, just assume that it is different this time, and we do default. Well, I'll tell you what happens. Global markets go berserk. global markets go berserk. And then I would imagine that the Fed has to go in there and buy treasuries, boatloads of treasuries again and again and again until they can actually sit down and fix the thing. I don't think it's going to get to that. I think, like everything else, you kick the can down the road, and at some point the can starts kicking you. And that, I think, is what's going to happen.
Well, I don't want to minimize any of the issues that are going on domestically, but it certainly seems like there's a lot more going on around the world these days. And obviously, we can't talk about geopolitics without talking about Russia and Ukraine. And my question for you on that is this something that is isolated to just those two countries? And clearly what we've just seen with tanks being now offered, I think the obvious answer to that is no. But I guess my bigger question is this a proxy war for something bigger? And maybe have we seen the start of a new Cold War?
Well, certainly the Russians are claiming that we're using this as a proxy war, right? And you always hear about this in the Middle East, don't you? That there's a proxy war going on for Saudi Arabia. We talk about that. They'll use, and then that's how this is being considered. And on the Russian side, or at least Putin's side, the tanks are becoming a hot button issue. That, in other words, they're coming in to Ukraine. He sees that as an escalation. But the fact, let's move for there. But one of the things that I look at is Sweden and Finland seeking NATO membership. I served overseas. I lived in that region. I never thought that I would see ever those two countries seeking NATO membership. This is a major change. And if you think it was bad for Putin psychology that the rest of his empire, the Warsaw Pact, coming into NATO bothered him, think about Finland and Sweden. Look where they are. So in terms of spending on military equipment, they are going to need major upgrades. Germany was supposed to do a major upgrade. I mean, it's always been about the US basically paying for everything. Germany now, they have a new defense minister. The last one left just over the weekend, but they are going to have to do a major upgrade too. With the tanks, this is where it is important, extremely important. Putin counted on a couple of things, it's clear. One was a very cold winter. Why was that so important for him? Because what he felt was it would divide NATO. It would be that the domestic situation would get so bad that people would say, why are you giving money to Ukraine? What about us? We're freezing. You're making us turn down the thermostat, and start really complaining about the expense that is now going towards Ukraine. But that hasn't happened. So he missed out on that. One of the things that is appealing to him, however, is this, and that is a debate within Congress as to whether or not the defense budget is cut in some way and spending for Ukraine is also cut. That's because we know that there's a debate within the Republican Party on that. And that's something he's hoping. He wants to break the solidarity within NATO, the resolve. And so having those Leopard 2 tanks, Germany has always maintained that if you bought those Leopard 2s from us, which Poland had, you need permission from us to do anything with it. And so you saw what it was, a last minute decision that Germany said yes, and Poland was able to send the Leopard 2s. Germany is now saying they will also send it. We're sending the Abrams tanks. The thing is, it's easier for the Ukrainians to use the Leopard 2s. The Abrams is going to take a lot more. It's more complicated. But here's the point. Sweden and Finland are going to have to upgrade. But let's go somewhere else. Let's go to Asia. Japan, and basically making it a major decision that World War II, post-World War II, Japan is over. Now they are going to increase a budget for defense, and dramatically, not because they're worried about Russia, it's the neighbor next door. That's what they're worried about. And in the one of the newspapers that is really aligned, it's a organ of the Communist Party of China, but of the most reactionary one, sort of like the National Enquirer, if you will, had an article just recently. It said to Japan, knowing that Japan is the announcement that they're going to shift their military view, their perspective, they're going to build up a military. The headline was, "Watch out, Japan, you could be the next Ukraine." So that's inflammatory. But then you also have the issue of Taiwan. And this is fascinating because France and Germany had just had a bilateral meeting. And you can see in the stock market, they're up, right? Italy is up, France is up, Germany is up because of their link with China. They are the largest trading partners in the West with China, not the United States. And they came out with a statement saying, China is in, not out. Whereas the US is, and this is both sides of the aisle, more and more careful. Also take a look in Europe, in the Netherlands, and take a look and ask yourself, what is it about that market? Why is that up even more than France and Germany and Italy? It's one company, ASML, and it is a semiconductor, but it's a machine that manufactures, right? That manufactures more than just the chips. And it has been, the US has been trying to prevent anything going over to China. And they're saying, no, we have a relationship with China, we're going to go ahead. So this is becoming a thorn because you see the Chinese do not have a really deep infrastructure in the semiconductor business. Taiwan is very attractive to them for many, many reasons, not just Taiwan Semiconductor. They have long believed that Taiwan belongs with Beijing. They could do it the easy way. Remember how you say to kids, you can do this the easy way, you could do it the hard way. The easy way would be having pro-communist, pro-Beijing leadership in place, the way they did that in Hong Kong. Remember with Hong Kong, if anybody wants to know, how did they act? When the British turned over Hong Kong, there was an agreement, a 50-year agreement, that Hong Kong would remain autonomous for 50 years, right? Together, but separate, 50 years. Didn't take very long for the Beijing to come in and say, we don't really care for that. But they had a leadership by then in place that just changed everything. So Taiwan, this is the issue because the US has followed a policy for years of strategic ambiguity, meaning we support Taiwan, we do give them arms, right? We built a major cultural center. We don't have a consular office as such. We don't have an embassy as such, but we've got a major cultural center. This annoyed Beijing more than you can imagine because it's ginormous, it's modern, and we made a big deal about it. However, the rhetoric has changed. The rhetoric is no longer strategic ambiguity. It is, we will defend Taiwan. This is very different, very different. And it may be part of that larger strategy of saying, don't think you're going to go over to Vietnam. They're building islands that take them all into the sea. They're building islands, and then they're building landing strips that they say is for tourism. I can't even say it without laughing. It's meant for large planes that carry weapons, that carry tanks. These tourist landing strips. And you even have, war makes strange bedfellows, but even Vietnam is looking towards U.S. in terms of how do we protect ourselves from China? And this is a change. It's a change. And so when we had the plenum, I know this is too much that you asked for, but the Chinese had their plenum, their 5-year strategy meeting, the Communist Party. President Xi was unambiguous. No one is going to tell us what we do with Taiwan. Taiwan is Chinese. Taiwan belongs with China, and it will belong with China. We are not going to be told what we have to do with Taiwan. So this is going to play out not if, but when and how. All I know is that the incursions over airspace have gotten thicker and thicker and thicker with planes. And here we are. The Chinese right now are focused on rebuilding their economy. We've talked about that, restoring trade. They are going around the world talking nice chit chat, jaw, we call it jaw, even including with the US. But make no mistake about it. Their military is being built up, and I won't get into the numbers of warships. The US side, we have fewer, but we come out and say, well, ours are more sophisticated. We don't need as many as they have. But in history, what history has always shown, it is about the numbers. Who's got the most out there in the sea? So we don't. So all I have to say is it's a new world order, and every country is now grasping onto that. Why do you think that the gold prices are going up? Who's buying the gold? Who's buying most of it? The big whale in the gold market happens to be the People's Bank of China. And why? They want to diversify away from the US dollar. Remember when they owned $1.3 trillion worth of treasuries? Now it's down to about 800 billion, I'm sorry. But there was one thing that impressed them. You know what that was? It was how, when the war with Ukraine and Russia unfolded, the US was able to do all kinds of things to their bank, the Russian central bank. They don't want that happening in China. And so what we see is the People's Bank of China, the central bank, going out and buying gold reserves. We're seeing other central banks going out and buying gold. And that's one of the major reasons you're seeing gold prices continue to rise.
Quincy, I think we could spend probably at least an hour on this topic or more, but I do want to jump into, and if you have a few extra minutes for us, I'd like to talk about this, what it means for investors component. Do you have a few minutes to stick with us?
Absolutely.
So I want to talk about, I always let you, whenever we have meetings like this, where we have an economist or a strategist come on and we talk about all the things going on in the world and what's going on in markets and, all of these things that we think are going to happen, might happen. The thing I always think is very important for investors to think about is, should they now take everything they just heard and go out and make big changes to their portfolios?
Oh, you're asking me that?
I'm asking you that question.
Yeah. Well, no, I mean, there's certain themes that are trying, because we also pay attention to valuations. When certain ideas become too expensive, we wait until there's always going to be profit taking. There's always going to be a shift. And so let me share this with you. The US dollar had gone sky high against other currencies, right? And by the way, what that does is it's a headwind for US multinationals, of course, but it also tightens financial conditions around the world, given that the dollar is still the number one currency and transactions are in dollars. And so is it crazy to think that when the dollar weakens against other currencies, as the Fed has made it clear that they are becoming less aggressive, right? And that's how it works in the markets, that emerging markets would get a tremendous amount of interest and inflows. Are you still there, Bill?
Yep.
Okay, I don't know why this, oh, I know what it is. It's saying that my battery is weak. My battery is weak. And so money has flown into emerging markets. That's extremely attractive. They were very well compelling valuations. Money's going in, the dollar is weak. We understand that. It doesn't mean we jump in right away because money will pull out. I'll tell you when money will pull out and come back into the US. It'll be when the tech sector, which represents, big tech represents 22% of the S&P 500, the big tech names, those valuations are coming down. And at some point, investors from all over the world are going to take a look and say, hey, now may be a time to go back into those. So money will come out from other areas and come back into the United States. That said, what about the countries that are going to do a lot of trade with China? Again, we've talked about them: France, Germany, Italy. That's attractive, and we've upped our position there. Not overweight, but just upped it. That makes sense. That makes absolute sense. And so too does, for example, energy. That's always been a sort of one of our overweights. And, it got to the point where we're looking at it, oil prices had come down to where they were before the Ukrainian-Russian conflict. And it was like, oh my goodness, the energy complex is finished. No, it is not finished. Again, China's coming back into the market, and oil prices are going up. There is still a structural shortage of oil in the market, and energy companies, at least the big integrated names, are still delivering shareholder value. Chevron, I think, announced today that they're doing a major share buyback. The market likes to hear that. Dividends are being sweetened. In addition, it's a big market. And so, example, we listen to Halliburton. They are one of the major service companies for the energy complex, and they came out with a good report. So did Schlumberger. So all of the refiners are doing well. It's a very broad market. Many folks believe, oh, you have to have oil at $100 a barrel. Warren Buffett is still buying Occidental Petroleum, and they just need $45 a barrel. Anything after that is, as they say, gravy, liquid gravy, oil gravy. So it's still attractive for us. It's still attractive. We know the world is going green. We know it's going electric, but we need have stability in the energy market. And until we get over to that side, we still need oil. And I drive a Suburban. Okay, I need to be able to fill up at the filling station.
You need lots of oil.
Yes, expensive oil. Yes, but you get the point. And every time it seems to be written off, it comes back. And mainly it's because in November, the futures market in oil actually tends to come down, and then it starts to build up. But nonetheless, we're still there. We're still in that space. We also like healthcare, which with biotech. That's not going away. And I may add one thing. Investment banking has been, for all intents and purposes, dormant. And I think it was the CEO of Morgan Stanley who said during their earnings season, we expect investment banking to pick up as soon as the Fed finishes. Well, the Fed is going to be finished sometime in the spring, we believe, maybe even earlier. And investment banking lists are already being drawn up. Point is, biotech is an area, healthcare is an area for lots of deal flow. And that also helps to underpin that. And I've mentioned one more, and that is, because it's defense. We like the industrial space. And this is where you come out and say, Quincy, what about, I thought the world is falling apart. I thought there's a big recession. Why would you be in industrials? Because it's machinery, by the way, that's helped bolstering industrials, and also the defense names. Sure, there's a concern that the budgets will be cut, but again, around the world, defense spending is picking up. And so, but machinery, you might say, how is that possible? Who's buying machinery? Well, all I know is I drove out to where I am. I'm in Chicago right now. I drove from Virginia, where I live, driving through the Midwest. I'm looking at cranes all over the place, right? I'm looking at machinery at work. And so we tend to get, when we focus on these headlines, the headlines are enough to have you just go in and, just not get out of bed until this is all over. Life is going on. We just got the GDP report for the last 3 months, right? It was higher than expectations. The labor market is still solid. And one of the major hawks at the Fed, she's a head of the Kansas City Fed. She's retiring now. But she made a comment just last week. She said, look, the US consumer still has money in the banks. She said, we watch the banks. We know how much money is in the banks. We know where it's. She said they still have have money. Yes, they're using credit cards, but we don't see delinquency rates picking up. And she made the comment. She said, you know, I really do think there is a probability that we come out of this with a soft landing, or to use Chairman Powell's expression, softish or softish recession, soft-ish recession.
Yeah, I think we're all rooting for that, you know, if there is one for sure. And
Yeah.
Quincy, I want to take everything you just said there, and you talked about valuations, you talked about some areas for opportunity. You also talked about some global markets that look attractive. And I think the takeaway for investors from that is own a globally diversified portfolio, but then also at the same time, be disciplined in your rebalancing strategy. So you're moving away from those overvalued areas and taking advantage of some of those undervalued areas. And I want to, we touched on that 60-40 portfolio, which has historically been that benchmark for investors for a moderate portfolio or a moderately balanced portfolio over the years. And we've heard a lot of talk because fixed income markets were so tough last year that the 60-40 is dead. You know, so my last question to you is, number one, is the 60-40 dead? But if it's not dead, are there areas where maybe it needs to be tweaked a little bit?
No, I don't think it's dead. In fact, some of the top names in the fixed income market think the 60 should be the bonds and the 40 the equities. Jeffrey Gundlach, the bond king, right? And you know, he does a very good job in managing, but he looks at that, you know, he looks at the world now and says, you have an opportunity now that's not just about equities. You know, he talks about equities because they do manage equities, but he said this is an opportunity because especially if you go in now, rates are going to come down. That's actually where you do well, right? That's actually where you do well. And how do I say this? It's guaranteed, unless you're in the camp that, you know, guarantees from the US government don't count. We think that the government will pay back what it owes us in going in, and we feel comfortable. We feel very comfortable being there, and also investment grade. And if you're very brave, you go into high yield. If you think that a recession is not going to happen, now they're pushing out the year of recession 2 years out. Well, you know, it reaches the point where, okay, I don't want to worry about 2 years from now. You know, we don't know what's going to happen 2 years from now. But the point I'm making is that companies did a very good job raising cash when cash was so easy to go out into the market and just raise cash at attractive yields. So you know, nothing stays the same forever. Situations shift. I won't get into, I can't do it in this call, but even some of the comments from some of the hawkish members of the Fed. I mentioned Esther George, Chris Waller, who is a pragmatic hawk. He's come out with some very interesting statements that are different from what you're hearing from the Fed. And he's highly regarded. And he's talking about, I'll just give you one, because this is one which puts a different tilt on it. We've all been taught that the lagged effects of rate hikes and rate cuts take about 12 to 18 months to work their way into the broader economy, flowing into every crevice of the economy. Keep in mind that the housing market is based on the 10-year treasury yield, is it not? He made the comment the other day. He said, look, I've been doing a lot of research on this. I don't think it's going to take 12 to 18 months. He said, I believe in 6 to 9 months, mainly because of Federal Reserve communications. This is not hit. Everybody knows what the Fed is doing, not to mention the what we call the transmission mechanisms for higher rates. I think the full effect is going to happen much sooner. This is very different than everything we've heard. And so he's considered to be a pragmatist, a hawk, but pragmatic hawk. I take that seriously. And then on the dovish side, Lael Brainerd, who's the vice chair of the Fed, has said, I truly do not think that we're going to need to kill the labor market in order to reduce inflation. That's also, I mean, she may think it, but for her to come out and say it in a speech is different. They're very, very careful about what they say. And we're seeing a shift in tone. And I find this interesting. I don't know how Powell is going to be on February 1st. He may feel, for risk management reasons, he's got to act a little bit tougher. But what we're looking at is almost the end of the Fed rate hikes. I can't tell you. History dictates, I will go back to history, that the market doesn't really move. The market doesn't really see great inflows until after the last rate hike. I don't think this market is going to wait that long. This is a different market. It's a quicker market. It's a market that reacts immediately. Algorithms represent 40 to 50 to 60% of daily market volume. That this market's not waiting to get word from the Fed that they are finished. It's going to make up its mind more quickly. Now they've been, what shall I say? Their hands have been slapped, thinking that the Fed was finished back in the summer, right? Back in November, and they found out no, Feds keep going. But right now the tone is changing. The tone is changing, and I find that extremely important. It wasn't just dovish, a little bit more hawkish advice. It was with information about what's going on. And that's why I found it to be important.
Quincy, it's great to end on some positive, optimistic thoughts there, just in terms of where we are in this cycle.
Yeah.
I do want to thank you for joining us today, and all the clients and advisors of Cornerstone. We really, really appreciate you being with us today. By the way, for those of you who are still on with us, Quincy and her team, as well as Dr. Jeffrey Roach, they all collaborate on LPL's Market Outlook. That is out and available, so please contact your financial advisor. They would be happy to follow up with that piece after this call, and hopefully we can get this recording through compliance and approved, and we can push that out to everyone who wants to share with a friend along the way. So again, Quincy, I really appreciate your time. I really appreciate all your thoughts and insights that you shared with us today, and we'll do this again sometime.
I hope so, Bill, and thank you for your patience and flexibility in my having trouble logging on, but we did it. We did it. So I thank you so very much, and thank you for all of your information before this meeting. I really appreciate that. It was very thoughtful. Thank you, your clients on this call. We're there for you, and we try to make it understandable. That's our goal.
That's wonderful. You did a great job of that, Quincy. Thank you very much.
Be good. Take good care.
Bye-bye.
Bye-bye.